All right, all right, all right. Good morning, everybody. It is Monday, guys. That's right. You know what that means. It is time for some Macro Monday, Johnny.
Macro Monday,
Johnny,
same time, same place, and we're here again.
it's nice to see you. You're right over there. I see your face right over there. Johnny
Oh, are
Walkup.
you? Because you're right in front of me.
I'm right there. The best name in residential real estate you could possibly find.
Yeah, except that it's
Still love
pronounced
it.
penthouse. But other than that,
Johnny, fourth floor
that's my local
Walkup.
joke.
Johnny Charts, thank you for joining us today on another glorious Macro Monday. What a gorgeous day out there it is. Got a couple more
Oh my
days.
gosh! And the weekend, I thought we did have a little bit of rain Saturday night, but the weekend was just that
It's
weather was
lovely.
just crazy. I loved it.
It's lovely. Hopefully it continues, guys. We're going to get going, guys. It is Monday. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it's Monday. So you're going to get a little Macro Monday coming right at you guys. For those of you that are new to this show, we're going to start out with Manhattan real estate. We're going to go with a bunch of macro topics over there, and then we will circle back to Manhattan real estate. We will try to do all of this in 30 minutes or less. We will touch on some tradable market stuff. So no financial advice. None of this stuff is financial advice. Do not go day trading this stuff, John.
No, don't do it.
Don't click that buy button. Did I miss anything? If you guys got questions, please put it in the chat right over there. We love to hear what you guys are thinking, good, bad, or ugly. We could take it. We're trying to fine tune this show, make sure we're delivering the information you guys want. And we're going to start right now. John, you ready?
I'm ready, and I want to echo your suggestion to put some comments in there, put some questions. It's really great. Some of the questions we get generate really great conversations, and so I encourage folks to use that.
Yeah, use it. All right, let's start out with Manhattan real estate, just like we promised, guys. I am at the market ticker. You can see it right over here. We're looking at 30-day activity. We're almost at the end of the month. So we're going to get these prints soon. This is our guide as to how the month is going. In terms of new inventory, I see 2,029. I'm just going to check my notes over here again. 1,757, John. That's our average. We're at 2,029. That's like
coming a little bit on the build side on inventory right there.
It's coming in hot. So it looks like we're having a above average listing season to start out the fall listing, which was, I thought it was interesting given the whole election uncertainty thing that's going on. I wondered which way it would go. Would sellers pause or would they list? Looks like they're listing.
Yeah, I mean, I don't know if the election's what's causing them to list, but certainly they're coming onto the market. I don't know if it's hot. It's definitely warm, but yes, they are coming on right now.
I'm not saying the election's putting them to list. I'm just was questioning whether or not the uncertainty would have lent it one way or another, Johnny. You got to be very
right.
clear.
Well, there's even more uncertainty over the weekend, right? And Mayor Adams decided to leave the race, so now it's fresh back on the front pages again. The mayoral race.
Yeah, we're going to talk about this Thursday, October 16th. Little shameless plug right over here. I have two things Thursday going on, but at 1 o'clock, we're going to have Teresa Stevenson. We're going to have Jared Anton. We're going to have Jason Haber. We're going to talk about the election effect for an hour. So definitely join that one. But let's get back down here. 1 month supply coming in hot, guys. I don't know what the number is. I guess it's like 25% hot at this point. We'll see how that ends up. Contract signed, that is deal activity 672. That is supposed to be at 707. So far that's light. But one could make the argument that September is the listing month and October is the deal activity month. So we don't know whether or not there's pipeline activity out there that's yet to filter through there, John. But
it's true. Again, I always think on a weekend like we just had when the weather was out and the, like it seems like a great day for open houses. So I always hope that people get out there, see some place and be like, yeah, this is it. This is the place for me, and they sign, and then you get that due diligence done, you get into contract. So I'm hoping you're right. I hope we have some units working their way through the system now, which will emerge next week as contracts.
Well, if I go to the chart room and I go to liquidity, right, we could track all this, guys. We could see. Let's just go take a look at what happened last year. Okay, let's go back to 2-year chart right over here and go to last year. When did we start? We started rising like right after, like September 16th was our bottom. And we kind of started rising after that. So now you're at, September 28th. And we, I think we're past our bottom, but we haven't really moved anywhere yet. So it's off to a slow start just in that regard there. But we'll keep an eye on it.
Yeah. Okay. Well, I do think, and we're going to get to this, but I think there's a whole, mortgage rates that were finally kind of making their way back down again. They seem to have turned back around. So,
Yeah. Well, we got questions. We already got questions. Is anyone else finding the open houses are slower than usual? I'm getting only 2 to 3 per day from my open houses. What say you guys? Speak up. I mean, this is what we're trying to do here, is trying to get a place for all of us to talk to each other on a professional level. Got to keep it professional. Is there uncertainty out there that's causing a little bit of buy side pause right now, or is that just all talk? Might be property specific, but that's that. And then here's another question, John. Have you guys seen or heard an uptick in co-ops wanting to implement price floors? Ooh, I have a listing in where the board issued a memo indicating a price floor.
Well, I think I can dig into this one. I think you can too. So obviously, you guys may or may not know we have this advisor service in which we do a deep dive on your pricing. It's like a 20-page report, and we go deep. We go crazy deep. We've actually now done some for people who have co-ops who had rejected prices because of price floors. They're kind of soft, obviously, and part of what we've been doing is sort of writing a memo to the board saying, "Hey, listen, based on everything we can see about this unit, the price that you're hoping for is not going to materialize." So we have started to see a little uptick in that. Obviously, this is nothing official; it's just sort of boards being boards. But yeah,
and I wonder if that's concentrated towards a certain property type niche, say like older co-ops, maybe under 2 million, 1.5 million, stuff like that. In this day and age, but that's interesting. Yes, open houses are slow. We're hearing. Here you got more. Agree. Open houses are slow. That's interesting stuff right there. So, guys, we're seeing some agreement in the community. We're gonna watch this and we're gonna talk about it. What's going on out there? We're gonna keep an eye on this every Friday. We'll keep an eye on this as well, Friday and Monday. So, okay. Wow, there's more coming in. I just want to share this so you guys can see it. Okay, what open houses are not having the desired impact, next to dead. Oh my God. That's like, I don't know. Well, we'll see. I don't want to go too far until we give this some time. All I know is this is about when this is supposed to go up. And you know how you'll see it, guys? On this dashboard, 1 week, you'll see it right over here, right? You'll see this right here. Contract signed 175. If that does not go up, right? That should be at about 225 or so, I think, for the active season. So if that doesn't go up, we'll know right there. That's your ticker. Yeah. It's like your stock ticker for real estate.
It's really interesting to see the comments. Like, open houses are definitely not having the desired impact. They're next to dead. So
yeah,
that's very interesting to me.
All right. Well, we're tracking it and we'll show it to you. But we're getting some people feedback. We asked for it. Thank you, guys. Let's shift. Let's go to macro. We'll come back to Manhattan in 15, 20 minutes or so. We look at credit spreads, guys. Credit spreads is our canary in the coal mine warning signal. It's our DEFCON 1, 2, 3 that the military uses. I think the military uses in some capacity still. If it goes up, if credit spreads go up, something bad's happening. If credit spreads go down or narrow, it's risk on. The easiest way for me to explain this is to click max on this chart. And you can see the great financial crisis. You can see the pandemic. And then you take a look at where we are now, and we're just kind of going down. Now, there's been a change, John. Over the last couple of days or so, this is starting to go up. And it pushed us up. We were at stage 1.5 last Monday. We're at stage 1.6 now. What I like to tell people is that you look for moves of 2 or more. We just moved 1 level from stage 1.5 to stage 1.6. You can see it moved up right here. I consider that noise. 1 move noise, 2 moves a level. So if this goes up to the next level, stage 2.1, and this continues to go up, then we have to look at the stock market and see, is the stock market starting to go down? Right now, it's too soon to tell, but nevertheless, credit spreads are widening slightly, John.
Yes. Again, you zoom out and it's indiscernible.
Zooming out.
You can't even see it. So, I mean, yeah, it is like we've talked about many times how this is sometimes like watching grass grow. So it's like, yeah, we grew a little bit over the week. However, look, I mean, it is something to keep an eye on. They are starting to rise a little bit, but not in a meaningful way just yet. But again, it is something worth noting and worth watching, especially, like we just had a Fed meeting last week, and the Fed's torn between, we're going to get into this, the Fed's torn between, is the risk of the job market or is the risk in inflation? And right now they're siding with the job market. But, rising credit spreads could tell you that, yeah, there's definitely some risk out there. So maybe that's arguing for a dovish Fed still. But things are still in play, I should say.
Yeah, so we'll keep an eye on this, guys. A very, very, very minor light signal coming out here. Nothing too concrete and nothing that we're going to go crazy over unless, I should say, we see follow through. So we'll keep an eye on this every week. Right now, I don't see much. You did mention rates, John. I want to pivot to rates. Okay, guys, let's go over rates, tell you everything that you need to know about rates. We go to this table. It's the Fed Fund Futures. That's what this is. It's basically the bond market. It's the market predicting the future. Okay. Nobody's good at predicting the future, not even us. Okay. That's why we don't do it that often here at Urban Digs.
I used to be really good.
Yeah, what happened?
I don't know. I didn't see it coming.
I don't know, man. I think I don't think you ever had the touch to lose, man. I don't know. Yeah. Let's tell you what you guys need to know. The Fed already cut, right? The Fed already cut. So we were at this level right here, and then the Fed cut last week or a week and a half ago, whatever it is. So we're at 400 to 425. That's where we are now. Okay, that's what we have to note to ourselves. The next meeting date is October 29th. I mean, this is pretty high, John. 89.3% chance that they're going to go ahead and cut another quarter point. That's already priced into rates. Yeah. That cut. Okay.
Yeah.
Go ahead.
No, I'm just agreeing with you.
Oh,
I don't know. Okay. I don't have much to say other than the fact
I thought you had some amazing wisdom to pass on.
I just don't have the time these days, Noah.
Okay. All right.
No, you're right. Look,
here's
the deal. Here's the deal, though. We've seen this. I mean, look, the market is dead set against. Therefore, they think we have two rates coming. We had the first one in September. Definitely have one coming in October at 89%. And they're even thinking about one in December now, right? That's close, but we definitely have two baked in. And that's what. So, obviously, I'd like to look at the contrarian side, which is like, look, that's a month away, and it's at 90%, right? So if something happens on the interim to either suggest that the jobs market is not as weak as what the Fed is thinking, or what the data suggested, or that inflation's starting to tick back up, that 89.3% could shift all the way back down to 50-50, which could, again, that may be what credit spreads are starting to indicate, which is like a little bit of not quite sure what's happening here.
Maybe. I don't know. It'll be early. That'd be an early call if that's the case. I mean, what I'm seeing here is that, the market did have 3 cuts kind of pinned for this year. We got one of them already. So that's out, right? We got that a week and a half ago. The next cut we're going to get, October's 89% chance the markets are probably going to get what the markets want, because the markets are 5 years.
It's 89%. That's my point, is this 89% chance now. So it looks like a sure bet now, but in 2 weeks, if the data changes, like, oh, okay, we have to reconfigure. That's my point.
If that happens, rates are going to go up. If that happens, if you're right, if this number goes low, if this number goes from 89% to 60%, rates are going up. That's what that means. That's how you read this table, guys. But nevertheless, they got one more cut, and then it looks like this third cut. Remember this third cut that they were expecting? We still got it pinned, but that confidence number is going down. That was higher, and it's going down. So whenever these numbers go down, that means mortgage rates are now, maybe we're not going to get that third cut. So yes, on the next one, 89%. I'm not so sure about this December cut. That might change notably the closer we get there. So we'll keep an eye on that. Okay. Questions?
No, all good. I would love questions. I think we really like questions. So feel free to join in the chat there. It was good stuff.
Let's talk
house chat earlier.
Yeah, that was good. Let's talk about what the impact of all this is on rates, guys. I mean, this is rates. Okay, that blue is jumbo, light blue. That light blue is jumbo. That dark blue is regular 30-year conforming. But guys, if you see that uptrend right over there, that's after the Fed cut. And the reason is because these numbers, these confidence numbers went down. This was like 80, 90% also, and it went down. That's why rates went up after the cut. A lot of people don't understand that. We discussed that right here on the show beforehand. Yeah. That they can cut and rates can go up.
Yeah, well, the other idea is that, if the Fed is cutting rates because they want to stimulate the economy, right? So the front end of the curve goes down, the overnight rate goes down, but then the longer end, which is a little bit more risk averse, starts rising. So you have that 10-year note starts rising up because, hey, a little bit more risk involved, which is pushing pushing up the mortgage rates too. So yeah, just to your point, just another angle.
It just tells me that these markets are so dynamic and that it's not just about the move the Fed's making. It's about the statement the Fed's making. And it's about how the bond market reacts to the statement about the future. That's all that matters. And some people just don't think that way. It's a weird way of thinking. I understand. Rates. John, I thought this was really interesting. All right, guys, take a look at this. Yeah, this is interesting. The blue line is 30-year conforming. Okay, 6.2%. You can actually see it kind of here also, the dark blue line at the bottom. The gray line is 5-1 arms. Okay. Now go to the left of this chart. The left of this chart, which is like a year ago. Do you notice how the gray line and the blue line are so tight together? There basically was no difference between these guys until you got to earlier this year, like February and March. And then the gray line started to go down. It had a couple of moments, but like, look at the spread. Now go to the right of this chart and look at the spread between a 30-year fixed and a 5-1 arm. It's back up there to like 60 basis points or so, a little over half a point. So the bottom line is the arms are once again showing some value in the market that it didn't have for a while. That's what this is telling us. I don't know if it's foretelling something though, John. I don't know.
Well, so that's my question is I don't know how arms are priced. So I don't know why that spread has been widening out over the last year. And I would love a mortgage rate expert to tell me like, John, here's the deal. However, in the absence of that, I revert back to the idea that there's certainly value in that. So the question is, do you think rates are going to be higher in 5 years or lower? If you think they're even going to be close to the same, that arm looks particularly attractive right now.
Yeah, I wonder if the fact that there's a spread between these two indicates that we are generally in a declining interest rate, future, like the next 1 or 2 years. And that's why that's happening versus before.
But I don't know.
Yeah. Interesting nonetheless. So there's some value there. I wanted to point that out in case you have chats with clients. On the inflation front with rates, again, this is all jobs, economy, inflation. These are all kind of things that are impacting the Fed. The Fed is what controls rates. Rates is what controls kind of all the bond market and mortgage rates and all that kind of stuff. 2% target. I mean, it's going up a little bit, but John, we're stuck in this like we're down from where we were and we're just stuck like above their target. So this is why, guys, this is why the Fed can't just cut.
Yeah.
It can't, is because this is still kind of lingering above their target. That's what I'm saying. It's very tricky out there. There's a lot of this conflating disparate signals saying different things, but this is why the Fed just can't cut.
Right. I mean, they really are stuck between a rock and a hard place, right? So if the jobs market's weakening, they want to cut into it. But on the other hand, if inflation starts heating up, they can't cut into that. So they're really hemmed in. And what's interesting is when you go back and you look at that Fed probability table, you can see it because once you get past like January, February, it's just like a straight line down. People just have like no clue. Like, I don't know what's going to happen.
Yeah. All of this is just completely uncertain. Don't talk about anything past this line. Even this cut right here, that's in December. I don't even know if I want you guys like confidently discussing that. It's almost coin flip territory at this point.
Mm-hmm.
Okay. Be careful. So yeah, inflation's above the target. And that's why, guys, weakening jobs, lingering inflation, Fed's in a spot. So that's
I'm gonna take a look. I'm gonna put you on the spot.
What?
Are you ready?
What?
Are you ready for the spotlight?
What?
So we've got a new Forbes piece coming out. Hopefully we can finish it up soon. And I think it was mainly you who wrote it. And the whole point was mortgage rates don't exactly have the same effect you'd think they do in Manhattan real estate. And I thought you might want to dig into that bit because obviously we're talking about mortgage rates and how helpful they are when they go down.
There's no place to dig. It just doesn't have an effect.
Right.
I mean, mortgage rate basically went to zero all the while Manhattan did nothing price-wise.
Yeah. Isn't that interesting?
It more impacts liquidity and deal activity and it less impacts price.
Yeah. Anyway, I thought it was a little tidbit. That's interesting stuff. Good research by you.
Yeah. We're going to stay heavy with rates today, guys. We're going to stay in the mortgage element and stay away from macro inflation stuff for a while. Did you guys know, like you break down all the mortgages out there and you see how many people got less than 3% and then 3 to 4. And we know that this has been the situation because we were coming from 0% rates for so long. And a lot of very savvy people refinanced into longer term debt back then, right? Fueled a big housing bubble kind of thing that's rolling over. And, inventory has been so tight. And one reason is because of the lock-in effect, right? The lock-in effect. The lock-in effect was this idea that I got a 3.5% mortgage. Now the mortgages are 6.5%. Even if I want to sell, I'm not giving up my mortgage, right? That's the lock-in effect. So you look at this chart, and it's basically telling me that the amount of people out there that have those low mortgages is starting to fade, starting to go down. And the amount of people that have higher mortgages is starting to go up. And this is something that's been going on for a couple of years now. So it should start like a refi boom. And sure enough, it is. Okay, guys, take a look at this refinance index. You see how it's starting to move up? This is what I was talking about. This is the lock-in effect. Look at this period for the last 2-3 years. Soft. Now it's starting to go up. So we're entering a period where that whole lock-in effect is going to probably start to unwind itself over the next X years.
Well, let me ask you, do you think
happens.
that, look, Manhattan's, if just talking about Manhattan right now, supply's coming in about
different
20%
scenario
ahead of seasonal average, but do you think that's the lock-in effect that's
No.
unwinding a little bit?
I don't think that this is national. This is why we do macro. I don't know how much this specifically hit. I mean, Manhattan's what, 60% cash?
Well, I think part of the article that we're talking about is that there's so many local nuances to Manhattan, right? And over the last 10 years, you've had things that hit you from the federal, the state, and the city level, all of which impact prices and movement. And I think, when it comes down to Manhattan, as well as Brooklyn real estate, it's just a local thing. So mortgage rates are certainly a piece of the puzzle, but they're a much smaller piece of the puzzle here than they are in, say, Phoenix.
I would agree with that. I wonder if this is more a phenomenon that will be in the lower end, the 2 million and under market as well. What's going on over there? I think you might just start to see inventory unlocked, especially across the nation. Less so in Manhattan. If it is in Manhattan, more so in the lower tiers.
Yeah,
but it's just very early stages. It's something that's different that we haven't seen in years.
And just to echo back to the earlier question about co-op boards and price floors, I think some of the advisor reports that we've done for agents have been part of that inventory that's coming to market have been older estate sales.
Yeah.
Right? So these are not mortgages. They're finally like, all right, finally I can sell this one and buy someplace else because I got a new mortgage rate. This is like the time in this place is time to move on in general with their life. So that's the estate sale. So I would love to be able to do some sort of research piece that looks into what supply is coming on and where that is in terms of the mortgage rate lock-in effect. Was it a low mortgage rate when it was bought? Like, how old is it? That kind of thing. I don't know how to do it, but
we talked about that years ago. I think it's time we actually try to dig into that. We got to get some research people. We got to get our act together. All right, that's interesting, Johnny. We're almost done here, guys. This is one of the last slides for macro. Did you know? John, you said you knew this. I did not know this. Whenever I think of like investors, who owns single family rentals that are out there and buying homes for rental kind of a thing. I don't know why, but in my head, I keep thinking that BlackRock and all these big firms and hedge funds are buying up swaths and swaths, thousands and thousands of places and just renting them. And then, you'll eat bugs kind of a thing and pay us forever. But this chart totally just dispels that myth. And basically, 89.6% of single family rentals are just landlords that own between 1 and 5 properties.
Yeah, it's a lot of that. It's a lot of that mom and pop landlord stuff. And I don't remember how I know this, but I did know this. And part of it is digging into the data for townhome sales across Manhattan and Brooklyn, is because sometimes you have something labeled as a townhouse, but it's got 5 units in it. It's like, okay, well, it used to be a townhouse and it got carved up. So it's like, all right, well, where are we? And so going through that process, you realize just the sheer number of mom and pop, 3 to 5 family buildings are out there. And there are a lot of them in the city. And I think, once you start adding them together, like that number of buildings just dwarfs all the other ones.
Yeah. And again, I just put this in here because I thought it was interesting. I don't know if you guys are going to encounter the need of this information on a daily basis in your jobs, but I thought it was something, maybe a nugget of wisdom, maybe you can just know and have a general idea about. Kind of like how long are people holding properties and selling? A lot of people think 6 and 7 years. That's like 12 years now. Like the average holding time for a house is like 12 years. And it's like, whoa, what
Yeah.
the hell did that change?
That's funny
no,
because
no,
I
no.
was thinking the same thing. It did expand a little bit, and maybe that's going back to the mortgage lock-in effect. I'm not sure, but it
Maybe.
certainly has gotten
Yeah.
longer. Maybe it's because people just love the city. I hope that's the case.
Maybe. Back to Manhattan, Johnny. We did it. We did it in under 30 minutes, under 25 minutes, which is fine. We're gonna let you guys go and do your work. But guys, this was important. We discussed this on Friday. Okay, guys, I want you guys to visualize. This is Manhattan. Visualize the wave of activity that this market gets. And we broke it down by main neighborhood. Okay, downtown, midtown, Upper East Side, et cetera, et cetera. But they all pretty much follow the same patterns. And we are right in the beginning of it. So I just want to reiterate to you guys, know where you are in this cycle. If you have clients that are thinking of listing in the next 4, 5, 6 weeks, pull it forward. Pull it forward. And the one thing I got to say is that we have the election November 4th, right? It is possible. If you think back to last year, uncertainty before the election was rising before the election. Then the election happened, right? And that uncertainty went down and a lot of people made decisions. Whether the outcome was what you wanted or not, uncertainty went down after the election. This time around, we got the election November 4th. So I would expect a similar type of uncertainty cloud to like linger on a market on the buy side. Just don't expect buyers to be super aggressive in this time. And if you're waiting for after, it's like, all right, let's wait till after the election. Certainty goes down. Now you missed the wave. Yeah. And that's the point. So just keep in mind where you are and how long it goes, and then when the next cycle is going to hit.
Right. So the reason we did this, basically we normalized seasonality. And so we went down to -1 to say, and then to +1. So right around 0 is neutral. But it's interesting. So when you look at it, you're right. So we are in this upswing, but you can see like that tailwind from seasonality in the fall, nowhere near as strong as it is in the spring, pretty much for every single main neighborhood, but especially for things like Upper Manhattan, which, you know, it hits its peak in, what is that, March, April? That's the peak for that market, maybe even to May. And then the rest of the year is kind of like, it's not on vacation, but it certainly doesn't have anywhere that same sort of competition that buyers normally face. Upper West Side, Upper East Side, they're a little bit better in terms of that fall seasonality. But again, you know, spring remains the major market here. So if you're on the market and you're hoping for some kind of competition in the fall, you're probably going to get it. You're just not going to get the same levels that you've seen. And it's just kind of, you know, nice to see around that corner by saying, look, this is the fall. So yeah, we're getting buyers, but we're not going to get the same ones that we're going to get in the spring.
Johnny, how do people get this chart?
Well, you can take a screen grab, number one, or you can email me at John@UrbanDigs. I'd be happy to share it with you for all of our Macro Monday viewers who we do appreciate you. So I'd be happy to. Oh,
I love Dale. Dale's, that's the way to do it. You gotta act quick. You don't know how long it's going to be up there.
You know, we did this. So I'll tell you this. We did this for Brooklyn, and the Brooklyn chart's different. It's different. There is no
seasonality in Brooklyn main neighborhood. It's all over the map.
It's all over the map. I mean, there's definitely, you can see some waves, but you'll have some at a peak at the same time, some are low. It's really interesting. And we also broke the Manhattan one out deeper into, and we'll put this up on UrbanDigs for subscribers. You can see how the different price levels and co-op types, you know, co-op versus condo break out across the thing.
Yeah.
But I want to go back because there's an interesting question about the idea that has the percentage of cash buyers in New York City dropped recently, and I believe it has, but it's still up there, and I think it's still definitely over 50%.
Yeah, I think it's over 50%. I think it was like 65, 60. It was some crazy number a few years ago. I think it's come down, and I remember Michael Romer, I believe it was talking about this on a session and basically said, you know, anecdotally speaking, I'm seeing a lot less cash deals come in. You know, now granted that was on the contract side, not on the closing side. But yeah, Nikki seeing that she's reading somewhere cash buyers. We always listen to what Nikki says. Chances are it's reverting down a little bit, but I don't know what the actual percentage is. Still above 50, I think.
Yeah, I don't think I've unpacked that in a month or so. So time to go back to that.
It's just below 60. I thought I read. Okay, there you go. That sounds about right to me. Still a lot. All right, we did it. We did it, guys. We did it. There's only a couple of things I want to plug tomorrow. If you guys know this, we got Juliet Clapp, we got Itzy Garay, and we got Dan Morello tomorrow. Tomorrow, 11 o'clock, we're going to talk about industry best practices. That should be an interesting conversation. What?
I got to say, Kara, please show us Brooklyn. Do you have the Brooklyn one handy?
I do not have it handy. Email John.
Yeah, you can email me. I'll share you the Brooklyn. I'll share with you the Brooklyn one.
Email John.
If you don't have it handy.
That's okay. I just want you guys to know that tomorrow we're having a session there. We'll talk about best practices. I think it'll be really interesting. Thursday on the 16th, we got 2 things. I want you guys get ready for this. Again, we have the election on Thursday, October 16th, 1 o'clock. And then at 11, we have Phil Horrigan's what's going on with the state of the market, which people should join. So keep an eye out for that. Other than that, I'm done here, John. I don't know if you have anything else you want to say.
I just want to follow up. So this goes back to the original discussion at the beginning. I find that most buyers coming to my listings are in rentals now. Interesting. Well, I hope they're able to convert some renters into the buy side now, because, prices haven't quite started increasing. They've actually, if you quarterly reports, by the way, are coming out. And so that price action is a little bit muted. You'll see some year over year declines here and there. But this essentially staying in this narrow band. So
the rental market is what's really hot. So, and that's probably the rental market's going to remain hot. Sales market's just going to go sideways for a while. I don't see that changing.
Yeah. Thank you, everybody. And again, if you want these charts, email me, john@urbandigs.com. More than happy. We got the Brooklyn ones. We got the Manhattan ones. We got all sorts of charts at UrbanDigs.
We got a lot of charts. Awesome. Thank you, guys. Thank you, John Walkup. I am Noah Rosenblatt. Thank you guys for engaging us today. This has been Macro Monday, and we'll catch you guys next time. Cheers, everybody.